Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. This is still continuing. What we are looking at with food prices, energy prices, it has gone into the next level. I'm going to show you that today. The first thing I want to cover is much higher prices. They're coming. I'm going to show you something that JP Morgan happened to say, but I mean, just look around you. It's pretty obvious. And the second thing being the incoming recession. It isn't just Larry Summers, which I'll show you in a second, Larry Summers saying that, but you look at all the different indicators and they are piling up. So all of that and more, let's begin right here, taking a look at this particular article out of Business Insider. And it's talking about how commodities could see another 40% upside as investors remain under allocated to the space. And why? Because it hadn't been performing well for so long. Obviously, this is the way the fund companies work. When things are real hot, they put more money into it until it gets way overweight, and then they start to flip. Now, looking at this further down in the article, they get some points here, and there's a chart down below I'll show you as well. Commodity prices could see an additional 40%. The commodities include oil, metals excluding gold, and agricultural products, which have all surged amid Russia's invasion of Ukraine. Actually, a lot before that, but anyway, we see room for further increases in investors' allocation to commodities. If you look down further here, you will see, with other conditions remaining the same, a shift to above 1% in the commodity allocation metric would imply another 30 to 40% upside for commodities. This is unbelievable to think about where we are today, historically so high, especially with what I'll cover in just a couple minutes here in the next article. And thinking another potential 40% on top of that, just crazy. So this chart is basically just showing us from 1999 up until the present, looking at the implied commodity allocation by non-bank investors globally. So most people, they have a very small percentage of their portfolio into commodities. They want tech stocks, they want, whatever type of stocks they're getting into, not commodities. Why? Because they didn't get the performance. They didn't see the performance. They saw a performance of Amazon and Apple and Tesla and so on, and that's where they want to allocate their money. But is that going forward? Like, is that the best idea? Well, if the potential for 30 to 40% higher in commodities is there, maybe so. I just got an email from somebody today, and actually they donated to me, and they said basically, I bought this particular fertilizer company back in January because I saw what you said in your videos. It has doubled in price since. And so he said, thank you very much. I think it's important that we see what's happening right now and simply, don't put all your eggs in one basket. Don't put any money you can't afford to lose, but realize what's happening. That's all I'm saying. Okay? Look, is today's energy shortage worse than the 1970s oil crisis? That's the question. And look at the potential answer. Today's energy crisis, which includes not only oil, but also natural gas and coal, could be even worse than the infamous oil crisis of the 1970s. We're not going to know until it's all over. Who knows where this is going to end up? We are in the middle of it today. Some say it's the early part, some say it's the late part, I don't know. We're somewhere during the middle. So that means that we will see in the coming months, in the coming years, how this all unfolded. And as of right now, there's nothing easing up. It looks like there will be more and more force applied. But what we could see is that demand destruction. We'll talk about more later in this video. And if you haven't already, make sure to hit that thumbs up button. When you do, you're supporting the channel, and I really do appreciate that. Russia's first default in a century looks all but inevitable now. Government breach of terms on dollar bonds this week. US and EU impose tough sanctions because of the invasion. Now, this is from April 9th. Still very relevant when you are seeing this, which should be on the 10th. Russia's first external default in a century now looks all but inevitable after another brutal week for the country's finances. First, the Treasury halted dollar debt payments from Russia's accounts in U.S. banks, ramping up its restrictions on the country. Then, when an attempted hard currency payment was blocked, Russia breached the terms on the two bonds by paying investors rubles instead of dollars. Okay, so this is going on. The cost of insuring Russia's sovereign debt has soared. You can look into this for yourself, see the details of it yourself. What we have here is essentially trying to force Russia to default. Russia saying, hey, we got all these rubles here. And they're saying, we don't want rubles, we want dollars, knowing that they're sanctioned, knowing that they can't get the money out, knowing that it's been so difficult to do business on their systems, on their terms. And yet they're saying, no, you can't do business that way. Kind of making it hard for them to make that happen. Cheers. All right, excuse me. China is an important manufacturing base for the global supply chain with dependency up to greater than 90% for certain categories. If you look at this, at the bottom, it's basically saying China's export as a percentage of the world, excluding China, demand. And along the y-axis, up on the top and the bottom here, China's export year-over-year growth percentage in 2021. So you can compare a lot of these different things. And you know this already, rare earth materials over 80% coming out of China. Okay, and you just see the difference here between steel, that's right here, and so on. I think it's important to look at what China does with anything. Their voracious appetite for commodities is extremely important to manufacturing, that a lot of which is done there, but the refining, which may take place outside of China, as well as the imports and exports that countries are doing. If China doesn't have that demand because of local demand dropping, you got a problem going on in other countries. At the same time, right now, as I've told you, the Shanghai port is completely closed. That means all the stuff has to move over to Ningbo, and Ningbo has to deal with now, this huge surge of, stuff at the port. What's going to happen? I mean, come on. You've got the busiest port in the world shut down, and you don't expect that to have an impact on the global supply chain again? Huge. US sanctions Russian miner producing 30% of the world's diamonds. Let me tell you the summary of this article. Everybody wanting to buy diamonds are going to have to pay more. Okay? We can move on. Diamonds are going to go up in price yet again. Quote, it's a huge problem. He said that global fertilizer supplies are very tight. CF manufactures and distributes fertilizers, obviously an inside source. Quote, it's a confluence of factors, unprecedented demand coupled with a huge fall off in a supply availability, only just exacerbated by the war in Ukraine and what's going on with exports coming out of Russia and Ukraine. All of this is a double whammy, if not a triple whammy. We have the geopolitical risk, higher input costs, and basically shortages. Agriculture is absolutely going to get hit. In the case of Canada, it's good for Saskatchewan, which is the largest producer of potash in the world. But farmers are going to get hurt because per acre, they're going to have to pay a lot more. They're going to get lower yield simply because they're economizing, particularly in emerging markets. All of these things together mean you as the individual have to pay higher prices for just about everything. End of story. That's it. So what does this mean in the total, in the aggregate? We have to look at this and understand, okay, investors, what's going to happen? Well, if you got the U.S. consumer, in particular the U.S. consumer, the Western consumer, highly reliant on this whole thing to just continue on and on, then we've got a problem because people won't have enough cash. That's going to have an impact on the average individual if their companies aren't getting, people don't realize this, I think. Who cares about those stocks? Well, those stocks are a representation of companies. If those companies aren't getting good performance, if their profits decline, well then, they are going to lay off people, and that's when it affects you. The price of the crop nutrient urea have surged almost fourfold amid supply scarcities, adding to cost inflation for growers. Quote, the situation is critical. We are losing money. Quote, at the bottom, it says that is going to cause us to stop planting rice because it is not profitable now. So this profitability affects companies from Apple all the way down to farmers in Peru, basically saying, what's the point of planting when we're not going to make any money? We're going to lose money. Unbelievable. It's not just about profit for you. It's about availability. This is why I tell everybody, get your stuff in order. Not when you need it, not when you need it, it's before you need it. These are the different commodities. Here you can see the 12-month price change. Natural gas. I mean, just look at this. You would think like some of these ones are small if you're not looking at the scale. Okay, well, you got this big one at the top and, a few others. Look at the return on something like this. Look at just, corn. 50% return in a year. If that was a normal year and you got a 50% return on anything, you would say, wow, that's fantastic. 50%. It's on corn, ladies and gentlemen. Wheat, 60%. Look at coffee, 65%. Your Folgers, your Nescafe just returned to 65% year over year. I mean, this is crazy. It's crazy. It's historic. And we're living through it today. But people out there, they're just interested in the weirdest thing. What's the next hot stock for today? What's the next penny stock? Like, what's the next meme stock? You're drinking coffee every day, and you're not even not you, of course. You're watching this video. These people, they're drinking their coffee every day. They're eating their corn chips and their pizza and pasta, and they're not seeing the fact that the prices are rising so considerably better and more consistently than all of these other things out there. And I've been talking about this for literally 2 years now, every single day. We got to get wise to this stuff. We got to realize what's been happening and that it's going to get worse. There's a twofold, the investor side as well as the personal side. Now, let's talk about recession really quickly, okay? I know I'm running on long, but I want to touch on these things real quick. Summers sees consensus building towards inevitable U.S. recession. It doesn't take a genius to figure that out. He talks about the increasing costs. He talks about all the things that we have, the supply chain and so on. We know that, and the numbers have been adding up. Look at this. This is the big one for the stock market. Fed and big tech. Central bank liquidity and the market cap of big tech. Do I need to say more for everybody just listening and not watching? We are looking at a chart from 2009 up until the present, and these two have been completely and entirely correlated. Looking at the stock prices of the big boys, comparing that to the central bank balance sheets. I mean, come on. If the balance sheets are declining, what's going to happen? Well, you tell me. Look at the way it's been over the years. You tell me. Oh, but there's disruptive stock, so we don't need to worry about all that stuff, right? Okay. Treasury returns are sharply negative. When you look at what has happened here, inflation is real hot. This generally doesn't end well, okay? This doesn't end well. Look at the comparison between the VIX index and the MOVE index. VIX index is roughly a measurement of the stock market's volatility, and the MOVE index is the measurement of the volatility of the bond market. And these two, despite the fact that both are very volatile, the VIX index completely suppressed. The MOVE index just continues to head higher. It's unusual when you see that kind of thing. US long yields usually do not rise much further after the curve inverts. So we had this inversion and then it has flipped around the other direction. And usually as soon as it flips around, it isn't much longer before we get into a recession. But will yields rise? I mean, these are all questions that we have today. I think it's important to follow it all. Of course, on this channel, I will do that for you. We are looking at all of these different indicators, piling them on one after the other. Without the Fed support, this is going to be very, let's just say challenging to have any growth. We need another stimulus package. We need, What is it going to be next time? $10 trillion from the government? What, 5 trillion maybe? Is that going to even be enough this time around? We will see what the government does and their response to all of this. If you want to support the channel, one very simple thing, just hit that thumbs up button to do that. Literally, it's right down there and you support the channel as well as you make it more likely that these videos end up in your recommended feed. So I appreciate that. And of course, I'll see you on the next one. Take care.